All right, welcome to the Memberverse Podcast, where we interview people making an real impact on the growth of the fitness industry. I'm your host, Dave Pancham, CEO of Go Pancham, your fitness marketing agency for freeing up your time and increasing your bottom line. Today, we have an incredible guest, Adam Williams, a business attorney turned tax strategist and the founder of Pennywise Tax Strategies. Adam's helped business owners across the country legally reduce their tax bills, keeping more of their hard-earned money, build long-term wealth through tax planning. What's interesting about Adam is he doesn't just talk about tax strategy. He's actively working with entrepreneurs every day to help them implement these strategies, and the results speak for themselves. And with major tax changes potentially on the horizon here, this conversation probably couldn't be more timely. So Adam, thanks for joining us today. And, to kick things off, can you share a little bit about your story? What led you from law to tax strategy to starting Pennywise?
Sure. Yeah. I mean, I tell people that I'm an entrepreneur turned lawyer turned entrepreneur. I grew up in a very entrepreneurial family. My parents always found a way or made one and had some success. But like a lot of entrepreneurs, they wanted something different for their kids. So they said, oh, go get a job, right? Go work at some big corporation where you work 9 to 5 and get consistent paychecks and health insurance and retirement and all that. And I did. I got my law degree. I got my MBA. And I got a job at a Big Four accounting firm in their state and local tax department. I lasted at that job 366 days because I had to stay a year to keep my signing bonus. And I left. I got a job working for a judge. And then about 6 months later, started a law practice and did that for going on 15 years, I think it's been. And the irony is I built a law practice to serve small businesses and entrepreneurs, but I started it in Erie, Pennsylvania, which is not the entrepreneurial mecca that most people would think it is. So we had a lot of success throughout the pandemic because with all the new programs and benefits and crap that was going on, we were able to help people in 41 different states. So the law firm grew like crazy. We were doing some really cool stuff. We've been several times on the law firm 500 list of fastest growing law firms. We last year made the Inc. Regionals list for fastest growing companies in the Northeast. And then this year we made the Inc. 5000 list of fastest growing privately held companies in the country. So to do that as a law firm is exceptional. To do it in Erie, Pennsylvania is like still unbelievable to a lot of people. And through all of that, what we found was with the different pandemic programs that were out there, my wife's a CPA. So full disclosure, I'm the co-founder of this business. She is and you know this, Dave, she's the better half of every aspect of this. But what we found, we're digging through these financials and tax returns and stuff for our clients. And we learned that a lot of our clients were having the same experience that we would have, where you meet with your accountant in the first quarter of the year, you send them your QuickBooks or your Excel spreadsheet or your shoebox full of receipts, and they go back behind the curtain and punch some numbers into a form. And then they come back and say, hey, you owe the IRS $150,000. Congratulations. This is what it means to be successful. And like any true entrepreneurs, we said, there's got to be a better way. And that's the business that we launched, where we're taking what typical small businesses deal with their accountants, and we're flipping it on their head, and we're providing the services that the millionaires and billionaires you hear so much about not paying their fair share. We provide those services to small businesses to help them proactively reduce their tax bill. So it's been a great transition for us. Jackie loves doing this work to help small businesses and empower them and put more money in their pocket. I love doing this work because I'm trying to defund the IRS, and we make a pretty good team with that stuff.
Yeah, full disclosure, we work directly with Adam's wife, Jackie. You probably hit on maybe a lot of people's origin story into trying to figure out something different, which is, they hand things off to their CPA and then all of a sudden like, what the heck is this? Why is that a big mistake? Well, why is that I can't just trust my CPA to do the right thing for me here and help me save money?
I mean, there's a handful of reasons for it. None of them are very good. To start with, the industry is just broken. We are trained by our accountants that they're going to send us I don't even remember the name of it. It's like a tax planner or something, a tax binder. They send it to you on December 31st and you answer some questions, and then they go and file your tax returns, and they're completely swamped for 2 months of that out of the year. And they can't respond to emails and they can't get back to you. And it's right up until that April 15th deadline, and a whole bunch of their clients, they have to put on an extension. And then what do they do April 16th? They go on a much needed, well-deserved vacation. So we're not trained, accountants aren't trained to deal with their clients on this stuff throughout the year. So that's the other part of it, is they may not know any better. Legitimately, tax preparers in particular may not be aware that there are things that you can do throughout the year to reduce your tax bill significantly. Like, we're not talking a few dollars. We're talking about like taking a hatchet to your tax bill. So I think there's a lack of knowledge. I think the industry is broken. And then I think the other reason, and this is true for lawyers too, so I'm not just taking a shot at accountants, is they're very risk averse people, which is the opposite of most entrepreneurs, right? Like, throw me into the lion's den and let's go. And I'm going to find a way to get out of this and make money doing it. So accountants tend to substitute their own judgment for their client's judgment. And they say, this thing is risky, or this may get you into trouble, but there's no truth to it. And for many of our clients, they're saying, well, what's the risk? What's the downside? What am I facing if I do this and it goes right or it goes wrong? And it turns out that when you have that conversation with clients, they say, oh, well, that's nothing. That's not a big deal. Let's go for it. And then we have clients farther down the spectrum who are like, anything you can do to save me any penny from going to the government, let's go for it. But that's the point, is you've got clients on that spectrum of risk appetite. You have a tax code that's tens of thousands of pages, which has all kinds of gray area and room for interpretation and advocacy. And accountants just make the decisions for their clients, as if their successful clients who are making a bunch of money can't make decisions for themselves very well. So I think those are the big reasons that we see. There's probably more to it than that, but part of the reason that our business has been so successful is because we're merely educating people about the fact that this is possible. And it's eye-opening to accountants, to lawyers, to financial advisors, to insurance people, to marketing companies, with a lot of marketing companies, to, gym owners, you name it. It's really eye-opening. I mean, I have a business management degree. I transferred colleges partway through, and I have an MBA. I've taken Intro to Accounting 3 times because I wasn't very good at it. The third time I took it, I think I got a B-. No one ever taught us this. Like, no one ever explained, there are things that you can do to create your business the way that you want to create it, and create your life the way that you want to create your life in a tax advantageous way. So we're on a mission to educate people about this. It's why we love opportunities like podcasts like this, because people will hear this and go, oh, yeah, all right, this makes a lot of sense.
So quick question here. So what is the difference between accountant, tax preparer, and tax strategist?
Yeah, this is the ultimate question. And I'm really glad that you asked it, because when Jackie and I do a lot of like live presentations in person to people on this. And when we pull up the slide, this is when all the cameras come out and they take a picture, because we break it down on this little pyramid. So this is the big issue, is that when you have a business owner that says, I need an accountant for my business, no one ever bothers to ask them, what type of accountant do you need? Because nobody knows that there's different types. The accountants know it, but they never bother to explain it to anybody. So let's go through the layers here. This is going to be really educational. There's probably, I don't know how many categories I'm going to give you, 5, 6, 7. The reality is, when you're first starting out, when your business is brand new and you're the entrepreneur doing everything, right? You're re-racking the weights and doing training sessions and cleaning the bathrooms and posting on social media. You're also filling most, if not all, of these roles as accountant. So the foundational level, the basic, is just bookkeeping. And this could be in QuickBooks. This could be in Xero. Some of our clients use. It could be an Excel spreadsheet, but just tracking your revenue and your expenses and categorizing them. This is like foundational stuff. Without that, you can't do any of the other things that I'm about to outline. This is the type of role that I think of a lot of entrepreneurs, a lot of business owners, they want to handle it on their own so they can see where the money's going. So they'll go put in their 10, 12-hour day, get home and collapse on the couch and start categorizing expenses in QuickBooks. This is the type of job that it's very valuable, but it's also very low skill, which makes it very easy to delegate to somebody else. So whether it's somebody in your business or outsourcing to a company or finding a contractor, like, get your bookkeeping out of your own hands and let somebody else do it so that you can focus on interpreting the numbers, not just entering them. So that's layer 1. Layer 2 is a payroll company. Sometimes your bookkeeper will do this, sometimes they won't. But processing payroll, right? We know how it works. Make sure the direct deposits go through and your employees get paid, and some of your contractors get paid, and your payroll tax returns get filed, and the taxes get remitted. this is another one that's like the companies that do this, whether they're the big national companies or the local mom and pop, they've built systems and they're so efficient at doing this. It's so cheap. There's no reason why any entrepreneur, any business owner should be doing their own payroll, because it'll take you hours and you can pay somebody else. I think when we had 25 employees, I think we were paying like, I don't know, $100 or $200 a payroll period. Like it's nothing to have somebody else do it. So we got bookkeepers, we got payroll companies, and then we start getting into the higher level stuff. So one category would be a managerial accountant. So this is someone that helps you run the business. So this might be like a CFO or a controller. So they'll do budgets and projections. And if you make this hire, or if you buy this thing, or if you launch this marketing campaign, here's the expenses that are going to go along with it. Here's the revenue that you need to generate. So they're really helping you make decisions about the business. This is probably one of the last ones that you delegate, because most of us entrepreneurs, again, we're going to make decisions differently than accountants will on this stuff. So a $50,000 expense to us will look a lot different than it will to our accountant, who's probably pretty conservative. After managerial accountants, you've got financial accountants. This is what most people think about when they hear the term accountant. This is most CPAs. They're backwards looking. They say, how did we do last month, last quarter, last year? And they prepare your financial statements, your profit and loss, your cash flows, your balance sheet, things like that. They're very reactive. They're backwards looking. Their job is compliance and making sure that things are accurate. So it's important in making decisions in your business, but it's also looking backwards instead of forwards. The managerial accountant is the one that looks forward. Then we have tax preparers. And again, it could be one of these other categories who's also doing your tax prep. God forbid you're doing your own tax prep. The role of the tax preparer is to put the numbers on the forms, hopefully in the right amounts and hopefully in the right sections. So these are what we're used to dealing with the April 15th deadline and the frustration of here's your big tax bill, congratulations, or not understanding what they're doing. Their job is, they think very black and white and just report the numbers. And then there's us. There's the tax strategists. And these are the people that are meeting with you throughout the year. And I know we're going to get into some of these strategies and saying, all right, have you considered this and this and this? And, oh, you want to do this thing? Well, let's see if there's a tax advantageous way that we can do it. And I mean, I was listening to a recording this morning. Trump's got some new stuff coming out that I need to talk about on another event later today. But he wants to close some of the tax loopholes for billionaire sports team owners, whatever the heck that means. But there was a study done where the woman who serves the beer in the arena made, I don't know, $28,000 a year, and she was taxed at 14%. And LeBron James, who was playing in that same stadium, made $20 million that year, $200 million that year, $200 million that year, and he paid 33% tax. And then Steve Ballmer, who owned the team in the arena, made $1 billion that year, and he paid 14% tax. Well, why do you think he's doing that? Because he's meeting with his accountants and his lawyers throughout the year saying, hey, I'm going to make $1 billion. What can we do about it? And they find things to do. As small business owners, it turns out a lot of those same opportunities exist for us. Can we all go buy a new Gulfstream jet and write that off? No, but I mean, some of us can. So let's go and do that. But there's so many other things that can be done. And that's why we created this business, because turns out there's a ton of opportunities out there and people just don't even know about it.
So I think it would be fair to say that, tax planning isn't just for the wealthy, uber wealthy, or even moderately wealthy, I guess you'd say.
No, I'm it's funny. I'm trying to come up with, I need marketing help with this. I'm trying to come up with a little magic statement or USP around that of like, yeah, we're bringing tax planning to the common man, except it's not the common man. It's man and woman, and it's entrepreneurs who are not common. They're exceptional, but yeah, I mean, we're entrepreneurs with big tax bills. We're bringing this to you. So,
all right. So let's for somebody that maybe is never used a tax plan, I'm using an accountant. I'm just dealing with what I'm dealing with here. Guarantee that there's tax opportunities that they are missing out on. They're overpaying on taxes. What are some of those biggest missed opportunities that people are having?
Yeah. I mean, it starts day one with the business of what is the structure of your business? What type of entity do you have? So most small new businesses tend to fall into two categories. They either are a sole proprietor, meaning they never set up anything. The other category that we see a lot is LLCs, right? Everybody's familiar with setting up an LLC. A A lot of people think they can do it on their own online, whatever, but there's additional structures that are available. There's different tax selections that you can make that can make a huge difference. So I'll give you an example. We were working with some clients that came to us right at the end of last year, scrambling for last minute stuff when we're running out of time. And actually, we had two different clients. One was making $500,000 a year as a sole proprietor. She never set up an LLC. She never did an S corporation election. So we moved some stuff around and saved her about $17,000 just by properly setting up an entity and putting her on payroll and crossing all the T's and dotting all the I's. That's what my wife is for and the rest of our tax strategists. So we saved her a whole bunch of money just by making that entity selection. She didn't have to spend any more money. She didn't have to make any investment. She didn't have to go and buy a new SUV or, some of the crazy things that you see out there. She just had to have a proper legal structure. The other clients that we had, it's important when you set this up initially to also review it periodically. These folks had a coaching business. They were each making about $1 million a year from this business. Their accountant put them on payroll, did the S Corp election properly, great, but never did a calculation of what their salary should be and was overpaying them each enough that on average it was costing them an extra $5,000 a year on taxes. So we went in and did the math and said, no, you shouldn't be paying yourself $168,000. You should be paying yourself $80,000 to $100,000. So we went and fixed that up and saved them each $5,000. So that like foundational level entity structure is always the starting point. And then depending on which one you pick, it opens up the playbook for a bunch of other opportunities.
So I know there's plenty of other like interesting things that are out there. Like one that pops up is like, and I'd love to hear about more of this. Is like, I understand that somehow you can get your kids involved in your business. Yep. And there's a write-off there. Can you elaborate on that one?
Absolutely. So as anybody who has kids knows, they're expensive. and Jackie would yell at me if I didn't disclaim this, but like you got to follow rules. But here's generally how the structure works, right? If you are a business owner and you're making $150,000 a year, you're going to pay on average probably 35% tax on that, like literally a third of your income to state and federal and local governments. If you put your children on payroll in your business, they have to have a real job. You have to pay them a reasonable wage. They should have a job description. So I have two kids. My 14-year-old has a job in the business. Our 7-year-old doesn't. She's too young to really add value in the ways that we need her to, although we're working on it. So my 14-year-old has a job description, and he does an awful lot of shredding because there's a lot of paper that goes through our office. And he unjams the photocopier because I jam it all the time. And he sends out handwritten thank you notes, and he helps us pack our shock and awe packages that we send out to prospects. And, he's got a job description, and we pay him what we would pay anybody to do that job. And the goal, if you can justify this, if the job is worth it, the goal is to put your kids on payroll, and you can pay them up to $15,000 a year tax-free. So if you're making $150,000 at a 30% tax rate and you can get your kid on payroll at $15,000, well, your income is going to be lower. You're only going to make $135,000. Your kid's going to make $15,000, but you're going to save $5,000 in taxes right there. Like, boom, done. So we do it with our son. It basically pays for his tuition at his school every year. Even if you're only paying your kid $5,000, $10,000, like it goes from a whatever your tax rate is to zero. And there's an argument, $15,000 is the magic number because that's the standard deduction on taxes. Nobody pays tax on the first $15,000 of income. That's the magic number because there's an argument. You don't even need to file a tax return at that number. We usually recommend that you do, but you may not even have to. The other really cool piece where you can supercharge this is when my son's in high school, we'll hire him to be our runner. We have a lot of deliveries that have to go around town, especially in the law firm. So he'll start earning more money. He'll have more responsibility. So we can not only pay him a reasonable wage, but we can also fund a retirement account for him. So if we set up an IRA, you can contribute to an IRA $7,000. I think it's $7,000 this year with pre-tax dollars. So if my son made $22,000, $7,000 goes into an IRA and starts creating wealth for his retirement and his future and his family. $15,000 comes in tax-free. And I just took $22,000 out of my tax bracket into a zero tax bracket. So this is why you see, especially with our clients, realtors who use their kids in marketing or use them for, if they're showing a house and they got kids playing in the yard. So they're models, they're actors. If there's office work that they can do, if there's cleaning that they can do. The other cool thing about this, and again, we don't do this we don't tell you to do stuff just to save money on taxes, but let's also be realistic. You're teaching your kids how to work, right?
Exactly.
You're giving them that work ethic. You're teaching them how to add value to a business. I grew up in a family business. Like I'm broken, man. I think about things completely differently than anybody else does. And now I see it in my kids. The way that they think about things and the way that they process stuff is like my son, both my kids go to the best school in town. And these kids are total maniacs. It's scary how smart they are, except the way my son thinks about business, because he sees it every day at the dinner table and in the office, these other kids are going to be working for him someday. And they're all going to be happy about it. So.
Yeah. Value of hard work. So, in like just talking about like expenses and stuff like that, what are there any things that, the basic business owner can write off that they don't even realize that they can write off? I'm sure there's like personal expenses. I know myself working remote business. I'm able to write off a portion of my rent. Now, not every listener is going to have a remote business. Some people would have physical business, but any things like that, come to mind that people probably don't even think about.
And this is where a good bookkeeper can come into play in the way that you categorize these expenses. We do see people miss a lot of opportunities, either in taking the deduction, or if they do get audited, they don't have the documentation for it. So the home office is a good example, because I'll teach you how you can save money with a home office, but I'll also teach you how your current accountant is probably ruining your life. So if you are set up as a sole proprietor and you've got a home office, you can write off certain expenses, right? So, and there's an IRS form where you do this calculation where you basically calculate what percentage of my home is my office. And another great example, there's even gray area in doing that calculation, because you can exclude things like bathrooms and hallways and mechanical areas. Yeah. Or you can add or subtract the garage depending on how you want to do it. So you can do that calculation, and then you get to write off a percentage of your rent or your mortgage interest, your utilities, repairs, maintenance, improvements, the decorations and stuff that are behind you. Even in our home, we get to write off a portion of our domestic services. So like we got a housekeeper that's here 5 days a week. Well, a portion of that becomes a business expense for us. But here's where most accountants screw it up. You can take that deduction if you are a sole proprietor, if you file your taxes on a Schedule C. But if you are an S corporation or a C corporation or a partnership, and you go to your accountant and you say, I want to take the home office deduction, they're going to say, well, you can't do that. And that's going to be the end of the conversation. And we did this for 1 year until we went and learned that our accountant was ruining our lives, because we got plenty of expenses in our home. Technically, they're right that you can't take the deduction, but creatively, they're completely lacking, because you can do it not as a deduction, but as a reimbursement. So our businesses are LLCs that have made the S corporation election, and our business reimburses us for those expenses. So the business gets to deduct it, and we don't claim it as income. But this is where the tax planning comes in play. We can't do this in December for the whole year. It's too late. We're starting this in January now for our clients, doing the calculations, figuring out what numbers are going to go into that. We just upgraded the internet at our house to make it faster, because the business is helping to pay for it. And every month, our Jackie and I send an invoice to our business and say, all right, reimburse us for the portion of these expenses that we incurred. So that's another good example. I wouldn't encourage anybody to try and figure that out on their own. But if you really want to get into it, I'm pretty sure it's IRS Form 8829 that shows you how to do that calculation. If I'm right about that, I'm going to give myself a high five.
What about like vehicle write-offs? I hear all these crazy things out there, and the 6,000 pound vehicle. I see people getting G-Wagons and stuff like that. How does that work?
Yeah. Would you believe that my law firm owns a Ram 2500 pickup truck, and it's a legitimate business expense? So there's a lot of ways to write off vehicles. There's a couple different tax strategies that are most interesting to me, not because they save you the most money. Those ones are also interesting, but just because they're cool, right? I'm a car guy, so let's talk about cars. So you see the folks out on TikTok, and Grant Cardone has a video on this too of, go buy the 6,000 pound vehicle and you can write it all off and blah, blah, blah. It's so great. The rule is you got to use a vehicle more than 51% for business. and you can write off the portion that's business use. Where it got really fun was starting back in, I think it was 2017 when they passed the Tax Cuts and Jobs Act. You could write off of a 6,000 pound vehicle 100% in year one. So normally you buy a car and you may be able to write off the expenses over, I don't know, 5, 6, 7 years. But the game that people were playing is, I'm going to go into the car dealership on December 1st. I'm going to place my order. I'm going to take delivery of my car December 27th. I don't even have to make my first payment until January. And I get to take the entire deduction this year. Like that's a game that we like to play. Now, here's the problem. Since then, it's gone from 100% write-off to 60% to 80 to 60. This year's 40%. Next year will be 20. So it's the benefit isn't as great, but everybody thinks they're going to bring it back because Trump's back in office, and they're going to bring back, it's called bonus depreciation. So they're going to bring that back. The other thing that you can do if you don't want to go out and buy a car, like I get bored with cars. If it's 6 months, I'm like, all right, I'm ready for something new. You can also lease a vehicle and write off the business portion of that payment. So you don't get a big benefit in year one, but if your lease payment's $2,000 a month and it's 50% business use, write off $1,000 a month. Cool. All right, so let's supercharge this. One of the challenges is documenting and demonstrating the fact that it's 51% business use.
Yeah.
In fact, we just talked to a gym owner about this in California who was looking to buy, I think it was a Cybertruck. I just got my first electric vehicle, so I'm into this stuff right now.
Hopefully he wraps that with his gym's logo or something. That's his business.
I think she will, because she was putting on a lot of miles, which made the job easier. But here's one of the challenges is if you've got a home and you've got let's use the gym. It's a perfect example. When you drive from your home to your gym, that's your commute. Those aren't business miles. You don't get to write that off. Bummer, right? You don't get to track those miles for the 51% usage or 100% usage. But if we go back to the home office and we set it up properly, it's now not a commute from your home to your business. It's now business miles from business location number 1 to business location number 2. Oh. So now every mile that you drive that vehicle from your home to your office becomes business mileage. So those of us who are fortunate to have a fleet of vehicles, we may have one that we only use to drive back and forth to the office, and we get to write off the whole thing because it's just for business purposes, because we have an office set up in our home. So again, that's where we start stacking these strategies. Most likely you're going to be an LLC that made an S-Corp election. Then you set up the home office. Then you get to maximize your vehicle expenses because you have a whole lot more vehicle miles now. And again, none of those three require you to spend money in any different ways than you're already spending it, right? So cool stuff.
Yeah. Well, one last question about things that I kind of know a bit about, I've heard about, is the Augusta Rule.
Oh, yeah.
Can you elaborate this, and how does this work? How could this work for business owners?
So this is the portion of the podcast that people are going to want to come back and listen to, not because it's going to save them a ton of money, but just because they're going to sound so cool and so sophisticated when they explain this to their business owner friends. All right. So here's the story. You got the Masters golf tournament in Augusta, Georgia, and really rich people, high income, high net worth people go to that golf tournament. And the people that live in Augusta said, we're going to start renting out our houses. So we can rent out a house for 2 weeks. We'll go on vacation somewhere and make a boatload of money. And this is back in the Eisenhower administration. So it's the Augusta Rule, or it's the Eisenhower deduction. These people were frustrated because they claimed the income on their taxes, but they couldn't take any deductions. The IRS, the government, said, you're not a real business, so you can't write off repair costs, marketing costs, costs to stage it. Anything that you spend to get this ready to rent, that's not a real business expense. And oh, by the way, you have to claim the income. So they raised a fuss about it. And Congress actually did something useful and said, all right, new rule. If you have a dwelling that you rent for 14 days or fewer, you don't have to claim the income. Okay, kind of cool, but I have no interest in renting out my house. I don't want people drooling on my pillows and farting in my bed, right? So I'm not going to do this, except I actually know of a really good tenant that I could rent my home to. Maybe not for 14 days, but that's the limit. That tenant is my business. So again, got to be an S corporation or C corporation partnership. Can't do it as a sole proprietor. Can't do it as an LLC that hasn't made the S corp election. We host monthly strategic meetings in our home. We host marketing meetings in our home, our quarterly reviews. We shoot marketing content in our homes. And if you've ever rented a space to shoot content, a studio, you know what that costs, right? I do some coaching and masterminding. We host that in our homes. Well, if you've ever rented a conference room at a hotel, you know what that costs. So I get to send an invoice to my business for rent. So you can look up comparable properties. Again, Jackie's going to want me to tell you there's rules to follow and you got to do the calculations, etc. That's why she's good at her job. But if you go and do some research and you say, gosh, if I wanted to rent a space, like a wedding venue for a half a day to shoot video content, well, they'd actually make me probably rent it for the full day because I got to bring the camera crew in and have them set up. And then we're going to do all this stuff and then they're going to tear down and I can't do a certain number of hours. So that might cost me $1,000 for the day. Well, I'm just going to bill my business $1,000 of rent. My business gets to take that deduction. And so long as I stay under the 14 days, I don't claim that income. So another brilliant strategy. You're not spending any more. This is money I was already taken out of my business. Mm-hmm. But now I get to take it out tax-free instead of paying tax on it. Now, here's the reality. Even if you max this thing out and you did all 14 days, which may be getting a little greedy, you got to make a really good case.
Is that 14 days per month or for the whole year?
For the whole year. So okay. 14 days a year. Even if I did it 14 days at $1,000 a day, so it's a $14,000 write-off, that might save me, I don't know, $3,000, $4,000, $5,000. That's not a ton of money, right? But it is a cool story. But we can get pretty creative with it too, that if you've got a vacation home, you can do 14 days there too. They call it a dwelling. So as long as it's got sleeping quarters and a bathroom. So if you've got an RV, if you've got a boat, that checks those boxes. One of the first coaches I ever worked with used to do boat days, and you'd pay him a boatload of money. Pay him a lot of money to go out and have a VIP day on his boat. Well, then he'd take a portion of that money and pay it to himself as rent and get it income tax free. So yeah, that's a strategy that a lot of us who are either tax influencers or, for me, an aspiring tax influencer. We talk about stuff like this on social media because it's cool, but it's not going to take the chunk out of your tax bill that most people are looking for, but it can be a really great strategy. I mean, a couple times a year we have a videographer come into our home and shoot a bunch of content for us. So let's charge ourselves some rent for it.
Yeah. I know the Augusta Rule was something I'd never heard of before. And I still, like, people talk about a lot of stuff on social media. I don't see a lot of people talking about that. But, in terms of taxes and stuff like that, like what is the risky business? What's the risky stuff that, you shouldn't be doing? And like, where is that line? What do these lines look like? I mean, people write off probably way too many things or try to write off everything.
Yeah. I mean, it depends on what you're afraid of, right? Some people just try to write off too much because they're stupid. So we get people that come to us and say, how do I write off my Rolex? And it's like, well, I don't know, that like maybe we can make that case, but why don't we go do some easier stuff that's going to save you enough money to pay for the Rolex, and then we don't have to worry about this. So I think one category we see is people that just they make up their own rules in their head that sound logical, of like, oh yeah, I can write off dinner with my family because we complained about our employees for 5 minutes, right? Like, okay. I mean, again, we don't need to get cutesy with it. There's rules and guidance out there that we can make this stuff work with. So I think that's one issue is people just getting aggressive in a stupid way, not realizing that other idiots have tried this and lost, and courts have said you can't do this, right? That's the stuff that we go and research. Outside of that, it really depends on what are you worried about. Some people are worried and they say, I don't want to get audited. Well, that can be a challenge because the best way to reduce your risk of audit is to make less money. Well, no, thank you, right? Mm-hmm. So the next conversation is, well, if you do get audited and your odds go up as you make more money, we want to make it a really quick conversation. So we've had clients, whether we worked with them before or not, that the IRS, most audits are called correspondence audits, correspondence reviews, where they basically send you a letter and they say, send us this information. If you can present that information in a good enough way, the IRS auditor says, thank God, I don't have to deal with this one, right? And they move on to the next one in the stack. So I think a lot of people get worried, oh, I'm going to get audited. Well, listen, the IRS isn't kicking your door down with AK-47s and strangling your dog, right? They're
That's what I
setting,
think of.
well, everybody does, but they don't know. I can't tell you how many IRS audits I've survived. I guess not personally. I'm sure it's coming. But yeah, I mean, it's really not that big of a deal. And it'll be really interesting to see what happens with the presidential administration on that front. So if we're trying to reduce your risk of audit, make less money. If you're trying to survive an audit, that's what a tax strategist does. The number one reason that when the IRS comes in and says you can't take these deductions, the number one reason they say that is because you don't have proper documentation. So we create that documentation, like I was talking about with the reimbursement for the home office. And then there are some strategies that do get on the IRS's radar. And this is, again, I don't even love digging into the legal stuff, but there's some really interesting things happening. So the IRS publishes something called the Dirty Dozen list. And if your tax strategy is on that list, you better have a war chest built up, because you're going to be going to battle. And plenty of people do this because it's worth it. They say, my risk of audit, my risk of losing, et cetera, bring it on, right? Not everybody's like that. But so I'll give you an example. There was something invented a few years ago called the conservation easement. And I don't remember the specifics. I haven't looked at it in a while. But basically, you would get a group of people together and buy a piece of land. And then you would separate the rights on that land. So you would have the development rights, or the conservation rights, or whatever, oil and gas, whatever. And then you would, in some cases, still own the land and donate some of those rights to a charity. Or you would donate the land but maintain the development rights. I don't remember the specifics on it. Which sounds like a decent enough idea, except what they would do is they'd go buy a piece of property for $2 million and then say, hey, this donation that we're making to you, which isn't even the full bundle of rights to this property and ownership, this piece of it, this chunk of it, well, it's worth about $6 million. Well, the IRS didn't really like that. And a lot of people have gotten into trouble. It's been on the Dirty Dozen list. What's really interesting now is there's been some other Supreme Court cases where it wasn't Congress that said you can't do that. It was the IRS. And the IRS arguably doesn't have as much rulemaking authority as it used to. It can't make up its own laws. So there's actually some people are winning these fights now against the IRS in ways that they hadn't in years past. And then the other thing that came of it is people said, well, we're not going to do conservation easements. We got this new thing that's completely different. It isn't. It's a little different. And it's called a fee simple easement. And it's basically the same thing. Buy some land, donate a piece of it, or donate some of the rights. So yeah, that's the type of stuff that gets pretty aggressive.
Would the proper way to do that to be donate $6 million when it's worth $2 million and donate it for a smaller amount, or just the whole thing is a horrible idea?
I'm not going to go so far as to say a horrible idea. I am going to say it's super risky, and there is fraud out there in these programs. So yeah, it can be problematic. But on the other hand, that's not to say we don't have clients that don't choose to do it. You know, especially in business, depending on the type of work that you do in the industry that you're in, and we've had it in our business too. You have that lottery ticket year, or that one opportunity where you make a whole bunch of money and you're scrambling to do something. We've had some clients that pursue the fee. We work with a lot of personal injury attorneys. Mm-hmm. Well, their average case is worth $5,000-$10,000, and then they go out and they get that $10 million settlement, and they got $3 million of revenue come in, and they're like, I got to figure out something with this. I don't want to pay $1 million plus in taxes on it. So that's not to say that's the only strategy, but it is an option for them to go and do that. Yeah. So there's definitely some more aggressive ones out there. May or may not be a good idea depending on your circumstances. It's important to be advised of the risks on it. But yeah, that's the crazy thing, right? Is there's a difference between tax planning and tax reduction and tax fraud and tax evasion. I am a huge proponent of tax planning and tax strategy. Tax fraud, I don't encourage it. I'm going to get sued for saying that, I'm sure. But the reality is you don't have to commit tax fraud to reduce your tax bill, right? There's so many different things that like you said, I never even heard of the Augusta Rule. All right, well, if you own a home and a vacation home, or you own a home and an RV or a boat with sleeping quarters and a bathroom, I just saved you 10 grand right there. You got 2 kids that are teenagers, great. I saved you another 10 grand there. So we just cut $20,000 out of your tax bill. And this is the easy stuff. We're not even getting into the super complex high level stuff that we do with some of our clients.
Hmm. So I think the last place I want to take this is, what is potentially upcoming, right? We have a new president. There's potentially changing laws, potentially uncertainty. What are you paying attention to? What should people be paying attention to? Any expectations, predictions? What are we looking at?
Fortunately, I just went on Amazon and purchased a crystal ball, so I can completely answer. um, all right, so we're what, like 2 or 3 weeks into this presidential administration, and homeboy's bringing the hammer down. I mean, it's really interesting to see. If I wasn't confident in my ability as an entrepreneur to learn and grow and adapt, I would be completely terrified of what's happening right now. We tend to see nothing but opportunities in this. So it's every time they create a rule, people smarter than them find ways around that rule. So I'm going to give you an example. This is not tax advice. This may not come true, but just this is a completely fictional story. Donald Trump says, I'm not going to tax overtime. How many hours a week do you work in your business?
A lot more than 40.
Donald Trump says, I'm not going to tax tips. Well, do you have a tip button on your payment? Whether it's a point of sale or whatever, right? I mean, I'm not saying that it's going to be that easy to get around it, but I am saying that they will find ways to do this. So there's some big picture stuff. I'm actually going to do a Facebook Live later on this today because I think people are really interested in it, but I may end up sending out that recording too. So he doesn't want to tax Social Security, which only half of people that get Social Security actually pay tax. Tax on tips, tax on overtime, like cool. That's really kind of special interest stuff in my opinion. We do expect them to bring back some of these expiring Tax Cuts and Jobs Acts thing, like the bonus depreciation. There's also something called the qualified business income deduction. So for many business owners, the first 20% of their income, they don't pay any tax on. That's supposed to expire on December 31st. They'll probably bring that back. Trump's also saying he wants to reduce the corporate tax rate for products that are made in America. I don't know. It's going to be kind of interesting because he wants to put tariffs in place for these countries that buy all sorts of stuff that we buy all sorts of stuff from, but they don't sell us anything. They don't do us any favors. So he wants to encourage more American manufacturing. You're in a service business. Your customers are in a service business. We're in a service business. I may start saying, hey, what you're buying from us is a manufactured tax plan. Here's 100 pages of strategy, not advice. I don't know. We'll find some ways around it. So we're paying close attention to what he's saying. If you asked me 2 weeks ago if I thought we would be where we are now with Doge and the different things that are happening and the proposed buyouts of federal employees, I would have never guessed that they would get this far. They do want to pass the bill as, I don't remember the term, I don't get into politics, but they basically want to pass everything all at once. So it's going to be a tax bill and immigration reform and God knows what else they throw in there, and they want to do it in one shot. I think that's an uphill battle, but on the other hand, they'll probably cram so much crap in there so here's an example. The Tax Cuts and Jobs Act, one of the expiring provisions, and if anybody fact checks me on this, I don't want to be friends with you because that's not the point. I'm going to get close enough to the truth on this. There is a bicycle commuter reimbursement tax deduction in place right now. So if your employees ride their bicycles to work, you can reimburse them tax-free. And the limit is, I think, $120 a year. Maybe it's $240. Who cares, right? Yeah. If my employees, I'm sure there's people out there making high 6 and 7 figures that ride their bicycles to work. But for the most part, if you're riding your bike to work, you're probably not making enough money that you even pay any taxes. Who cares that this thing got in there? Well, probably what happened is some bike manufacturer lobbyist said, hey, squeeze this in there, right? So we'll probably see a lot of stuff like that. That's actually where the employee retention credit came from. They kind of jammed it into the CARES Act in the beginning of the pandemic, and then it turned into this major business for people helping businesses qualify for the employee retention credit. And I hope all of your gym clients went out and got that. In fact, there's still time. So yeah, it's going to create some opportunities, but it's going to be really important to pay attention. So Jackie and I were interviewed, this was a few months ago, by a reporter that's a huge Trump fanatic, and Erie's kind of a bellwether county for the country. So she wanted to get different opinions. So Jackie and I sat down with this reporter, and this reporter has a really good line that the media takes Trump literally, but not seriously. Trump's followers take him seriously, but not literally. So he says a lot of things that his supporters will go, yeah, it'll be close enough. Whereas the media is saying, oh my God, what 25% tariffs. This is never going to work. Meanwhile, there's an argument to be made that he used it for some really good negotiating leverage on some border security issues and things like that. So he continues with the same talking points he's had since the campaign trail. Trump met with congressional Republicans yesterday for hours, to the point where like one of them skipped his meeting with Benjamin Netanyahu, which is probably kind of a rude thing to do to the leader of a foreign country. And by all accounts, he basically just got in and repeated all of his talking points from the campaign trail of, I don't want to tax old people. I don't want to tax Social Security, tips, overtime, things like that. Somebody's going to have to go and write a law about that makes sense. That law, like all laws, will be incomplete, and some of us will find ways to make it work to our advantage. The people who don't know any better call those loopholes. I think the reality is the government is trying to create incentives and disincentives and some revenue generators. Bonus depreciation is a great example, right? That initially came out in the early 90s because American manufacturers of helicopters and airplanes were struggling. So they said, well, if you buy an American-made helicopter or airplane, you can write off 100% of it this year. Guess what happened? A whole bunch of people went out and bought airplanes and helicopters, right? I was able to take advantage of that a couple of years ago, which was pretty cool. But I mean, that's the point, right? They're gonna create incentives. They're gonna create disincentives to do the things that they want you to do. Another example of that is if you don't have a retirement account open for your employees to contribute to, you should. That's just a good recruiting tactic and wealth building tactic. But there's a tax credit available now that, if you spend money to set up that account, you can get a dollar for dollar reduction on your taxes. That's an incentive. They want more people to save for retirement, so they're gonna help facilitate that, or they're gonna try. They always screw it up, but now you're making me get political. So let's move on.
Well, I mean, just getting back, we have new president. There's a lot of change, but we're kind of like in a holding pattern, right? Nobody knows what we're going to be dealing with quite yet, or how things are going to trickle out. What are, at least at this point in time, like what are some key things that business owners should be doing right now at the beginning of the year to set themselves up for success tax-wise for this year? So regardless of what happens.
The rules can always change with the stroke of a pen. We plan based on what we know. And what we know right now is the current state of the law. So your bookkeeping better be on point and your entity selection better be nailed down now. And then we can start doing those things like getting you on proper payroll, getting your kids on proper payroll, documenting home office and the Augusta and some of these other rules that we talked about. If you own real estate, which has got massive tax benefits, there's some things called cost segregation studies that you can do. These things all take time. If you're waiting until April 15th to do tax reduction for last year, it's too late. If you're waiting till January 1st to do tax reduction for last year, it's too late. The millionaires and billionaires that are paying lower taxes as a percentage than the rest of us are worrying about this stuff right now. They're meeting with their accountants, they're meeting with their lawyers, they're meeting with their financial advisors, and they're putting a plan in place. So that's it, really. Let's make sure your bookkeeping is locked down. Let's make sure you got other stuff in place. We're going to plan based on what we know. Am I going to tell you this year that it would be a good strategy if you're looking for a new car? Would it be a good strategy to buy a car and put it into the business this year? I don't know. Maybe we can talk about it. We'll talk about other options. If they bring back bonus depreciation, you're going to see a whole lot of new Yukons and G-Wagons and Escalades rolling out in December, because that's why business owners drive those cars. All the wealthy folks in town that have second and third generation businesses, when I pull into my kid's school, that's all you see in the parking lot, because they're paying for it through the business, right?
They're being incentivized to do it.
Yeah, it's like, and it's funny because I teach a lot of business lessons to my team, to my clients, and on our podcast. And there's so many analogies between running a business and fitness, right? So it's like, if you want to lose weight this year, what do you think you should start doing? Working on it now, right? Yeah, like maybe take that last cupcake that's sitting in the container and throw it in the trash. Maybe step on the scale to get the baseline of where you are. And a lot of these guys probably have those fancy scales that are doing not BMI, but muscle mass and water content and bone density. And my scale does body age, which is the bane of my freaking existence. But that's it. Let's step on the scale, see where you are now, and then build a plan. So we're selling tax plans for 2025, and we sit down with people, and these are these 40, 50, 60 page documents that outline, here's everything that we think that you should do this year. And then we start implementing. So just so like we start the diet and exercise plan, we're starting to execute the tax plan. Now, something may come up, right? For the fitness example, you take a vacation, you get thrown off track. All right, we got to get you back on track. Your business may not go as you expected it to go. Could be better, could be worse. Maybe they pass a new law. All right, time to adjust the plan. But if we're going to wait until August, September, October, November, you're missing out on savings, like right now at this moment. Right now, February 7th, as we record this, really, really rich, sophisticated business owners with low tax bills are thinking about this stuff.
So, I mean, look, if somebody's never done tax planning before and realizing from these things you said here, the simplest things, I'm like, I am definitely missing out. What's the first step they should take?
Yeah. So, I mean, you can go to our website, pennywise.tax. We have some free resources. There's actually a guide that you can download there that's got some of the strategies that we talked about today, plus some others. And the reality is your accountant may or may not be doing some of these things, but if they're news to you, I can assure you they're not. We do have a Facebook group, Pennywise Tax Strategies. We're in there periodically sharing tips and updates and other free resources. And anybody's available to follow me on social media for tax tips and dad jokes and cool cars and aviation.
Love it. And just to close it out, I mean, like, any word of advice just to the average business owner out there? Because I think, sometimes taxes can be like just an overwhelming thing. Something that they want to run from. They also want to save money, but like any just general advice to any business owner when it comes to taxes.
Oh, dude. On taxes or just business advice?
You make it both then.
Yeah. I mean, business advice, go do 20 times more than you think you need to be doing right now. If I just heard Ed Milet say this, that if you're 90% finished, you're only halfway there. And I've found in our business that the more unrealistic my goals get, the more successful I become, the more money I make, the better my life is, the happier my kids are, the better my marriage is. So the people out there that are saying, I want to grow 5% this year, I want to grow 10% this year. No, dude, what's it going to take to double? What's it going to take to be 2.5 times where you are right now? Like, let's start really thinking about this. So that's my advice. I wish I had my book here. I wrote a whole book on this. So that's it. On the tax side, like I said, start now. If you want to book a call with us, fine, whatever. But at a minimum, hit up the website, pennywise.tax. Download the free resources. Stay tuned for the webinars and events that we do. It is going to be a fast rate of change this year. Again, as an aspiring tax social media influencer, you may or may not be seeing a lot more of my face. Hopefully you'll be seeing more of Jackie's face. So pay attention to it, because that's what wealthy people do.
There you have it, folks. I would highly suggest reaching out to them at the very least. Jump into some of those resources, watch some of the podcasts. It's only going to save you money over time. Adam, thanks so much for hopping on today. Again, really appreciate everything that you and Jackie have done for us. And I think I hope some people have learned a thing or two. I think even hearing this again has given me some good epiphanies and things I didn't even realize. So thank you so much, my man.
Cool. Thank you.